Hello and welcome back to StockSynops, and I'm your host, bringing you bite-sized lessons on the world of investing. In just 5 minutes, we'll break down key concepts to help you build your financial knowledge quickly and confidently. If you're new here, make sure to check out our first video on the basics of investing, where we covered saving versus investing and why long-term growth matters. Today, we're moving to the next step in our beginner series, understanding financial markets, stocks, bonds, and more. Let's jump right in. So, what exactly are financial markets? Think of them as big marketplaces where people buy and sell investments, just like a giant online store, but for ownership in companies, loans to governments or businesses, and other assets. The most famous ones include the New York Stock Exchange, or NYSE, and NASDAQ, where trillions of dollars change hands every day. But you don't need to go to Wall Street. Most trading happens through apps on your phone. We talked about beginner-friendly ones like Fidelity, Robinhood, Charles Schwab, Acorns, and Webull in our last video. Now, let's break down the main types of investments you'll encounter in these markets. First up, stocks. When you buy a stock, you're purchasing a small piece of ownership in a company. For example, buying shares of Apple means you own a tiny slice of Apple. And if the company does well, grows profits, innovates new products, the stock price can go up. And you might get dividends, which are like profit-sharing payments. Pros of stocks: potential for high returns over time. Historically, the stock market has averaged around 7 to 10% per year after inflation over long periods. Cons: they can be volatile. Prices swing up and down based on news, earnings reports, or even overall market mood. Short term, you could lose money, but over decades, stocks have been one of the best ways to grow wealth. Next, bonds. Bonds are basically loans you make to a company, government, or municipality. You lend them money, and in return, they promise to pay you back the principal plus interest over time. U.S. Treasury bonds are super safe, often called risk-free, because the government backs them. Corporate bonds pay higher interest but carry more risk if the company struggles. Pros: more predictable income, lower volatility than stocks, great for preserving capital or balancing a portfolio. Cons: returns are usually lower, often just beating inflation. So they're not as powerful for long-term growth. Then there are mutual funds and ETFs, which stand for exchange-traded funds. These are like baskets of investments. Instead of picking individual stocks or bonds, you buy shares in a fund that holds dozens, hundreds, or even thousands of them. For example, an S&P 500 ETF tracks the 500 largest U.S. companies, giving you instant diversification. Pros: super easy for beginners. Low costs, especially with index ETFs. Built-in spreading of risk. Cons: you won't beat the market dramatically, but honestly, most people don't need to. Steady growth is the goal. There are other assets too, like real estate through REITs, commodities, or even cryptocurrencies. But for beginners, starting with stocks, bonds, and funds covers the essentials. Why does this matter? Understanding these building blocks helps you match investments to your goals. Risk tolerance and time horizon. Want growth for retirement in 30 years? Lean towards stocks and ETFs. Need stability for a house down payment in 5 years? Bonds or balanced funds might be better. The markets connect all this. Prices move based on supply and demand, company performance, economic news, interest rates, and investor sentiment. Don't worry if it feels overwhelming. We'll build on this in upcoming videos, like how prices actually work and managing risk. To wrap up today, stocks offer ownership and growth potential, but with ups and downs. Bonds provide steady income and safety, usually lower returns. Funds and ETFs make diversification simple, perfect for beginners starting small. Pick what fits your goals, and remember, the market rewards patience. Please remember, this video is for educational purposes only and does not constitute financial advice. Investing involves risks, including the potential loss of principal. Always do your own research or consult a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results. If this cleared up the basics of stocks, bonds, and markets, give it a like. Subscribe for the full beginner series and comment below which type of investment sounds most interesting to you right now. See you next time when we dive into how the stock market actually works, buying, selling, and what moves prices. Thanks for watching StockSynops.